Hey guys, Whitney here. Welcome to today's boot camp. We're going to have a little conversation or a state of the union about asset markets and debt. I am so excited to be joined today by two of my colleagues, Eric Fitzgerald, Director of Acquisitions, and guys, I need to have my tea. I'm like losing my tea right now. Ed Gilmer, our Director of Capital Markets. But if this is your first time attending one of these events, we do our boot camp live every month. And really what the boot camps, how they differ from the master classes is that these are generally where we deep dive into skills. It's more of a workshop. We're helping you set up your systems to be able to evaluate and invest and just really kind of pick apart the deals that you're seeing in the passive investing market. Now, today we're taking a little bit of a spin. We're not doing a deep dive workshop, but instead, again, doing that State of the Union update, helping everybody understand what are the hottest asset classes out there, what's performing well in today's markets, what markets are performing well, and just, again, a little high level 30,000 foot view update on the debt markets and where we see those heading. Now, if you're here live, make sure to locate your Q&A box, okay? Don't go to the chat box to drop in questions, okay? That they get a little unruly there, but go to your Q&A box, and that'll help the three of us manage the flow of any questions that are coming in. As always, stay to the end of the show, because if I don't answer your question in order, we will get all those questions cleaned up before we leave today. Now, before we get started into our kind of State of the Union address, I would love to introduce Eric Fitzgerald and Ed Gilmer. Welcome to the show, first of all, but I would love for each of you guys to, introduce yourself and your role and how you kind of got into the space. Eric, why don't you start?
Sure. Yeah. Thanks, Whitney, for having us. Excited to be here. Like Whitney said, my name is Eric Fitzgerald. I'm the Director of Acquisitions here at passiveinvesting.com. I've been with the group about 2.5 years now. From Pennsylvania originally. I live here in Charlotte, North Carolina, down in the South. We'll never go back to the North. Started my career in property management in college and moved down to Charlotte, got a job as an analyst and then as an associate for a family office doing acquisitions. Got hooked up with passiveinvesting.com, like I said, about 2.5 years ago. Been really fortunate to have seen a lot of the growth that our company has seen in the last couple of years. And have a great team of acquisitions people behind me as well. So happy to be here.
Excellent. Ed.
Hey, I'm Ed Gilmer. I live in Merleton, South Carolina, along the coast. I've been with Passive Investing as the Director of Capital Markets for about 1.5 years now. Prior to that, I was in commercial lending for about 7 years in the Southeast. I met Danny, one of the partners, in 2016 and have been keeping in touch with him over the years and love watching what passive investing is doing and being a part of it now. So,
well, we are so blessed to have both of you guys on our team, and not only do they, send themselves. Ed's kind of like me, a one man department, slowly expanding, but acquisitions. Eric, how many people do you have on the acquisitions team now?
We've got 6 now.
Excellent. Yeah, we've got a deep bench of knowledge and experts working on behalf of our investors. Now, let's kind of open up the floor to some questions. And guys, those of you here live, I invite you to go to your Q&A box. You can find that at the bottom of your Zoom screen. It looks like you can just, if you don't see it, it's under more, you'll find Q&A and drop in your questions here. But I had some questions to kind of open us up with. Let's start with Eric. So what are the asset classes that are hot and performing well in today's markets? I mean, we've got multifamily, we got self-storage, we got express car washes, real estate debt. What's performing well in today's market?
Yeah, I think right now, still in a lot of our asset classes, the fundamentals are very strong, particularly in places like multifamily, self-storage, where occupancy is still relatively strong. I think obviously a lot of the headwinds that we're facing are more related to the capital stack and interest rates. But really, when you look at multifamily right now, particularly in the Class A space, delinquencies are very low. Occupancy is still very high. Now, you do have to watch out for new supply, especially in micro environments. So in markets like Austin, Texas, there's a lot of, even though one of our favorite employees, Chris Neary, is in Austin and really likes Austin, we're not necessarily looking there because of the amount of supply that's coming online, and rents are definitely softer as far as the growth. So you in the Class A space, particularly, you really have to watch out for the new supply that's coming online right now. And then in the Class C space, you really have to watch out for affordability with how fast rents have grown in that space, especially in the Class C space with the value add model and kind of flipping it in and out of apartment communities and raising rents 30–40% year over year over the last few years. That's not sustainable. So that's one thing that we're really trying to stay away from, is the Class C space for that reason, and for a couple other reasons, with kind of the Capex tsunami that's coming with a lot of these deals that kind of had lipstick put on the pig per se, and now there's real major issues happening with a lot of these older 1960s, 1970s type of assets. So we really still like the Class A and Class B space and multifamily. The fundamentals, like I said, are still very strong. But just obviously watching out for, interest rates and new supply and things like that.
So how are you keeping tabs on that new supply? And I also I haven't forgotten about the Capex tsunami, because I think that is a term that the investors are probably hearing here, largely for the first time. But let's take for one question at a time, how are you keeping tabs on this supply and demand trend?
Yeah, so we actually just got access to a database called Yardi, which a lot of people may be familiar with. We've historically used CoStar for a lot of our data, but especially in this market, we want to have more data than we know what to do with. And, our one source was CoStar, but we're really starting to get really down and deep in terms of micro markets, even smaller than some markets. So looking in neighborhoods and things like that, and making sure that we're keeping tabs on how many new deliveries are coming, what's the projected absorption, meaning how many units of those are going to be leased up, what's the demand in that market. And so we're constantly kind of monitoring our existing assets and new assets that we're looking at acquiring. What is Yardi saying about the new deliveries? What is CoStar saying about the new deliveries? What are brokers saying about the new deliveries? But if you ask a broker, you have to increase it by 10 to 20%. But just trying to get different data points to make sure that we're staying on tabs with the new deliveries that are coming online. And a lot of those new deliveries are coming online this year and next year because they're already under construction. And we see a lot of the forecasts from 2025 on to be much more depressed in terms of where new supply is coming online. So if there's an opportunity to acquire, an asset at a good basis and a good market now, we think for the first year and a half or two, there might be a little supply coming online, but after that, there's a pretty good runway for rent growth after that.
Eric,
Okay,
I'll piggyback on that. I mean, the supply of the next 12, 24 months is a result of pretty loose monetary the last 2 years. Multifamily development takes 2 to 3 years, maybe more. So the credit crunch of the last 12 months is going to mean in 2025, 26, you're going to have a tightening of supply coming online, which I think will drive rents up. Like you said, the next 12, 24 months, you're going to have a lot of units come online that got permitted 2 to 3 years ago. But in 25, 26, that's going to slow, and those assets will become more valuable. Simple supply demand there.
Then that was kind of what I was going to sound back, to Eric's comments. So thank you for filling in there, Ed. So, because I would say, I get all of the, Marcus and Millichamp and Cushman and Wakefield and, all of the, bullpen emails and stuff like that in my inbox. And, even though the news is trying to modulate a little bit, most of our investors are probably not looking at that type of news. They're looking at CNN or Money Market or, Forbes or something like that. And you get a very different picture being painted. So of what's happening in multifamily, there's an Armageddon coming here, with supply and demand. And so it sounds like this is pretty, modest delivery happening in the next, 12 to 24 months, but then we're going to have a nice window, where those asset valuations, will continue to climb. So I'm taking a little bit of left-hand turn from the questions I was going to ask you guys. Ed, where does that lead? How does that tie into the capital markets, right? Like if right now, if, Eric has already alluded to that debt is, expensive on these properties, are we going to see a nice dovetail in the next 12 to 24 months between debt and the asset prices increasing and these assets being affordable to exit at the price that we're hoping to exit at?
Affordable is relative. I think, let me answer your first question there. I think in the next 6 months, I think rates will kind of plateau. And then at the end of Q1 next year, I think we'll start to see the loosening of some rates start to trickle down between Q1 and Q4 24. Maybe we get back to hopefully 4.5% Fed funds rate by the end of mid 25, late 25. And that'll drop. A lot of these deals are SOFR plus. That'll drop these rates from like SOFR plus from the 8s down to the 6s, maybe mid 5s. Agency deals, I think will drop back into the 4s at that point, and that math just works better for everybody.
So how does, I know you and I have attended some of the same conferences this spring, and one thing that we heard over and over and over at these conferences was like, operators need to make it to 2025, have a plan to get to 2025. So what, we've heard this, over and over and over again. What should investors be looking for in a debt of an asset to know the operator is actually taking prudent steps to remain conservative during this time while maximizing the business plan?
Sure. So, continuing to grow rents on the top line, managing your debt. I would invest in a deal that did not have a rate cap involved or a fixed rate. So fixed rate or floating rate with a rate cap. You've seen some headlines recently of multifamily investors across the country that have turned properties back over because they hadn't had rate caps. They can't afford an 8%, 8.5% debt. All of ours, we have rate caps in place. The first year of extensions is just bound to the rate cap. So we're monitoring these on a daily, weekly, monthly basis, every single property we have as to what is our plan ABC down the road, and we'll be adequately prepared when this time comes.
And so so we know what our plan is, how does an investor know what their operator plans is? Like, is there questions they should be asking them? Or should they look for some key things in the offering memorandum? One thing you've already alluded to, does the asset that you're potentially investing in have a fixed rate debt or a floating rate debt with a cap? What are there other steps that investors can take to kind of feel a little bit more in control in this kind of very chaotic time?
Sure. Obviously, knowing the debt, is it again fixed or floating is the number one question. And two, if it's floating, what's your rate cap time and price, and are you adequately reserved for renewals? That's simple. That's first grade questions I'm asking here. So I would look at your guarantor's experience, the markets they're in, make sure they're in the best markets. And I think Class A indies kind of in certain times, the Class A product are going to fare better than your Class B, Class C's. Your tenants are stickier, they make more money, they can weather a potential recession, soft landing, whatever you just call it, better than your Class B, Class C tenants. We love Class A, that's all we're in, is 2015, 2017 or newer vintage properties, major metros, mid-major metros, and the Sun Belt. Every conference we go to, every investor we talk to, everybody's looking at the Sun Belt. I'd say North Carolina, Florida, Texas area, maybe some out in Phoenix a little bit, but being in the good markets with experienced operators and making sure your debt's in place and you have, plans or reserves for the future.
Ooh, I think you touched on a really good topic there, reserves. So this question I'll throw out to the both of you guys. What should investors be looking for in the business plan as far as like reserves? What is a good healthy pool of reserves that will allow people to sleep well at night?
That's a broad question. It varies property to property, but there's not a certain dollar amount or a percentage. I would say depending on your debt situation and your monthly cash flows as to what that would look like, making sure you have plans in place to properly fund your rate cap extension that comes up, or a refi. There's a word thrown out the first part of this year called a cash in refi. And I was like, what is that? You're saying it wrong. It's cash out. Cash in refis are a thing. That's not something anybody wants to look at, but on some properties, if you're looking to take them to agency, there may be a shortfall there. Maybe there's some extensions with a bridge debt, looking for some more interest only just to get to the other side of the rates coming down. Like I said, I think rates start to come down middle of next year, late next year, and then a lot of these deals that people bought in 2021 will start to make more sense. If I can answer one of the questions here that kind of ties into this, Whitney. Jay asked, do you anticipate a lot of multifamily properties becoming available for sale at the end of the year as a result of desperate sellers unable to get favorable debt as the loans reset? A lot of the bridge loans, so a lot of the multifamily volume was done second half of 2020 all through 21. I think Q4 21 was the biggest quarter of multifamily acquisitions in recent history. And so if they did a 2 or 3 year bridge loan, that 2 year bridge loan is coming up Q4 of this year. Most 2 year bridge loans have an option for 1 year extension by binding the rate cap. If they're not adequately capitalized, yeah, that deal might come to market. I don't think you're gonna find too many, fire sales or, foreclosures. But if they didn't have properly, if they don't have the rate cap in place and the rates are cranking up, they can't afford them, you're going to see some motivated sellers and/or foreclosures come to market. So, and that, I think starting Q4 of this year and on into next year will be the time when that you see more of those come to play.
Okay, so deals potentially coming, but maybe a longer timeline. Eric, what is your kind of thoughts on that?
Yeah, I think a lot of stuff that we're targeting on the acquisition side right now is merchant builders. So guys who have a huge pipeline of new developments coming online, and they're not necessarily a DR Horton or an institution, even though we are targeting those kinds of assets as well. But that's one thing that we're really targeting right now, because a lot of these guys have construction loans that they need to get out of, and their business model is building and selling. So we're targeting by name some merchant developers with some of our good relationships with brokers that we know have projects that are going to be delivering, and we know need to get out of that project. So I think some of those opportunities are coming with merchant builders. And like Ed said, I think it definitely depends on when your debt is maturing and what you did as far as a business plan and where you bought, what you bought. One of the good things with Class A compared to Class C is that on the exit, you have a lot more institutions looking at your assets, and institutions are back in the field now. They did take a little pause when the rates were shooting up, but institutions, we're seeing them back on bidding sheets. And so those are going to be your end buyers in the Class A deals. Now the Class C deals, there's a lot of smaller syndicators and newer syndicators that were buying those types of groups, and even just private investors, not necessarily all syndicators, that bought the deal with a bridge to do a value add on a 1960 deal. There's not going to be a large buyer pool at the end of that deal like there would be for an institutional quality asset as well.
Well, so I guess, does this open the upper opportunity for us to be looking at additional type of assets to bring into the portfolio? Like, what is kind of what can we share here?
Yeah, as far as multifamily goes?
Yeah.
Yeah, so as far as what we're looking at, like I said, it's a lot of the merchant builder, Class A assets still. Now we are looking, I'd call it Class A minus maybe. So maybe like a 2015 vintage asset has a large headroom between their rents and the rents of the new builds in that market. So some headroom on the rents for that type of deal. But really we're looking to match the business plan with the debt strategy like we always do. So trying to find a deal that maybe is in a really good location with a supply and demand imbalance, and maybe put some fixed rate debt on it and hold it for 5 to 7 years and just cash flow. That kind of deal would make a lot of sense right now. But we're also, like I said, with a merchant built deal, maybe they're in some trouble and they're not stabilized yet. I think that's when you need to match up the debt with the business plan and maybe go with a bridge loan, get it at a really good basis, operate it, and then refinance. But lots of deals that we're looking at. I mean, transaction volume is down about 80% this year to last year. So not as much on the market, but I think the thought is that maybe there will be some groups in some trouble. Maybe there's some merchant builders that'll be in some trouble, and over the next 12 to 24 months, we'll be in a good position to pounce on some of those.
Whitney,
Awesome.
I'm going to piggyback on that. I mean, Eric keeps sitting on basis. Buying an asset at a good basis in a good market is never bad business, right? We're discussing a deal earlier this week in a major Southeast market. I don't think you could build it for that price today, right? And buying a great asset in a great location in a great market at a good basis is never a bad plan. And debt today might be higher than you want. You can refi a year, 2 years later, but the asset is still a quality asset that's not replicable at that basis. That kind of, if I could tie into Brett's question here in the Q&A, basically he said, despite rate caps, he's seeing lower cash flow distributions than pro forma, higher operating expenses. When and how will these deals recover, and which asset types first? I mean, obviously I'm going to answer that from multifamily perspective, but I think a lot of investors in 2018, 19, 20, maybe had some good years, deals that you bought and sold and got turned over in a year or 2 years, hit some crazy returns. That's not sustainable. I think, Eric mentioned looking at these deals for a 5 to 7 year horizon is generally, when you go back 20, 30 years, most people hold deals 5, 10 years or longer. So I think these deals right now, this is gonna be a little blip on the radar. You've had rents pop up last year. They're kind of cooling this year. Debt's gonna come down, in the next year or two, and then we're back in a normal market. I think values more than increase. We'll end up, if I had to guess, by 25, 26 above where we were last year, 22, 23 prices. So in long term, multifamily is a great investment long term. There's no, that's not my quote. That's just is what it is, right? You might not have your 1 and 2 year in and out deal make your 25% in 2 years that you may have had for a second, but still long term, these things are going to be incredible assets if managed properly. So.
Now, Eric, I want to go back to something you said earlier about the Capex tsunami that's about to happen. So can you elaborate a little bit more? I mean, you mentioned, operators that put lipstick on a pig and essentially, you have to now sell in a tougher market. But, can you elaborate on that, exactly what that is? And, how can an investor spot if they are with an operator that's trying to pick up one of these deals?
Yeah, so the Capex tsunami, I have to give credit to a guy named Bill Ham. He coined that term, the Capex tsunami. But really what it is getting at is the popularity of the 1960, 1970 type of assets that you saw using bridge debt and kind of renovating a couple of units and then flipping it to the next buyer and saying, hey, look, we proved the concept and renovated 10 units and got $300 rent bumps. You can do this to the remaining 150 units and get the same return. The music has kind of stopped on that business model for the near term. And so what they've done is kind of not really think about and take care of the major actual functional issues on the property. So roofs, spoilers, AC, like all the kind of things that make a property a good place to live in, weren't necessarily taken care of by a lot of these operators. So if you're now the person that has one of these deals and you're trying to sell one of those deals in this market, those buyers are going to do due diligence on your deal, and they're going to find all the stuff that was not taken care of, and that price is going to go down. And probably even before due diligence, they're going to be able to find out, what you've taken care of, what you haven't taken care of. So that's kind of been the MO over the last few years, is buy a deal, put some new cabinets in, some new appliances in, and new LVP, and get a nice rent bump and flip it to the next guy without taking care of the actual issues of the property. So I think that's something to watch out for. And as far as your second question, as far as how can you see or how can you tell if somebody's going after that kind of deal as a passive investor, I would look up when the property has been sold recently in the last few years. And if this is one of those deals that's been flipped 3 or 4 times over the last couple of years, that's probably a sign that this thing has been, flipped and renovated and flipped and renovated. And also, seeing who were the owners, and if it's, a small time syndicator and they held it for 8 months and flipped it, they probably didn't take care of a lot of the larger issues on the property.
Like the plumbing, right? Or the roofs. Well, guys, we're almost at time. I do want to open this up to a little bit more Q&A style for a few minutes. But Eric, we kind of took a left-hand turn, really got into the debt conversation. We'll come back to that as we have a couple more questions here teed up from investors. But we talked about where some of the hottest places were to invest. You kind of alluded to a few places where not to invest. But do you have any broad strokes, suggestions for, places where investors might look to shy away from? Are there any markets that are past their prime that, investors should just say, hey, let's wait for that particular real estate market to cycle?
I think one market we've seen a lot of interesting things going on in is Phoenix, Arizona. So a lot of trades were happening in that market in the last few years, and a lot of rent growth. They're actually, I think, leading the nation in rent decline now in Phoenix, and that's a function of how much those rents have grown in the last few years. So Phoenix, Austin, really Huntsville, Alabama. And really what the metric we're looking for there is new supply as a percentage of the existing inventory in that market. And then how much have the rents grown in the last 2 or 3 years? So then looking at affordability, what's the median income in these areas? What's the average rent? Is it lower than a third of their monthly income? So things like that I would watch out for. And Phoenix, Huntsville, and Austin come to mind as some of those markets.
Awesome. Thank you so much, Eric. All right. Ed, question for you. So, you were talking about the strategy on matching the debt with the business plan of the asset. And, for us, over the past few years, we did put bridge debt on, some Class A multifamily property. Can you speak a little bit to how we are, what our business plan is internally, where we're at with that, and that, like you said, the plan A, B, C, and D that we have lined up to get to see these assets to success?
Sure. So, one, I love fixed rate debt, right? Makes my job a lot easier, but rates are just too high right now, right? And for a lot of these deals that were bought during lease up, they were just too new to do bridge debt. So, too new to do fixed rate. So bridge was the answer. And the concept of bridge is to get you from here to there, right? Here to there might mean a year or two, or it might mean 3 or 4 years. So with all these bridge deals, all the 2-year bridge deals, the first option is extend the loan for 1 year. There's no DSC test, no debt yield test, just down to the rate cap, right? I think the price of rate caps is going to drop significantly in the next 2 to 3 months. Once the Fed stops raising rates, which hopefully was last week, or at least signaled there's not going to be a lot more increases. The rate caps are priced on future rate models. So that's going to be the option number one, I think, for most of these bridge deals that have a 2-year bridge would be buy under the rate cap for a year, and then that gets you 12 months later. All bridge deals are 5-year deals, be it 2-1-1-1 or a 3-1-1. So you potentially have 5 years there if you really needed it. Traditionally, the plan has been use it to get the asset, refi, and get out. But in this market, maybe use one of the extensions, buy under the rate cap, and put perm debt on it or fixed rate debt on it when rates are lower, a year down the road, 2 years down the road. So.
Awesome. Guys, I want to ask one kind of parting question of both of you. And I thank you so much for your time and just really helping, investors, understand, where we're at with asset classes, where we're at with markets, where we're at currently with the debt, what is kind of like the, the forward projection, right? We have a crystal ball, but like, is it cloudy or not, right? Like, and how far ahead can we look? What is kind of the top takeaway that you want investors to get from our talk today?
Sure.
Eric, Ed, we'll start with you. Thanks for raising your hand.
I'll volunteer. I think like Eric mentioned, I mentioned buying a quality asset at a good basis in a good market is always a good business plan, right? Buying at the top of the market in a questionable market, maybe a B or C asset, that might work for a year or two. That's not going to pan out long term. So, just focus on that, focus on the quality of the operators, and the debt structure you have. Make sure there's plans in place to hit your target horizon, 3 years, 5 years, 7 years, whatever it is. So
awesome. Eric, you.
Yeah, I think looking for a well-capitalized group is very important. So, somebody who has experienced, success in the past, is well-capitalized for when things inevitably go through a down cycle, and are able to survive and push through and continue, building the portfolio out in the next upswing of the cycle. I think this had to happen. This downward kind of trend in the cycle had to happen for the market. I'm actually like, I don't know if I'm glad that it happened, but it was, 2021 was a lot of fun for a lot of people in the business and investors. But I think it did have to happen. And, as long as, like Ed said, you're focusing in on the fundamentals, I think there's going to be a real story with the supply and demand imbalance from 2025 on. A lot of the developers that we talk to and the brokers that we talk to, there's people walking away from land parcels. I was just talking to a group earlier this week that we're really close with, that was doing a new development in Texas, and usually they get about 10 term sheets and are able to kind of pick through which group they want to work with and kind of needle point on different terms, things like that. They only got one term sheet, and it was not financially viable terms for them to develop the deal. So, this property, probably 350 units that would have definitely gone up in an up market, is now just going to sit and is just going to be a piece of dirt, and they're not going to go through with the purchase of the land. So that's a small example of a large trend that's going on, and I think that supply and demand imbalance is definitely coming in the 2025 and on. So just focusing in on those fundamentals.
Awesome. Well, guys, thank you so much for being here today, sharing your knowledge and expertise with us. Guys, you can reach them on the passiveinvesting.com website. We will have our next boot camp. We will start a monthly cadence. It will be the second Wednesday of every month here going forward at 11 a.m. Mountain Time. Look for that to start in September. Long story short, guys, thank you for being here today. We are going to pause the recording for everybody that's here live. We will clean up the rest of the questions that are more individualized, so don't go anywhere.